We said we should consider issues related with inflation, but what is the effect of depreciation? See, depreciation is basically a non-cash charge, right? It does not involve any cash outflow, but still we consider it as very important item in capital budgeting because this is going to affect the tax. And on what amount depreciation is provided? Depreciation is provided on original cost, right? So original cost is your historical cost, and this does not suffer inflation. It means we have to take depreciation with what? With zero inflation because it is provided only on the original cost. Okay, to understand, let's take a small case study. Here we have, today is 1st Jan. A company's PBDT on 31st December would be rupees 10,000. Inflation is corrected as 10%. Okay. Annual depreciation is 2,000 under straight line method. The real discount rate is 4%. Assume tax rate is 40%. You have to compute the money cash flows and real cash flows for 3 years. You have to compute the present value. Use different methods to arrive at the answer. So first of all, we have to arrive at the cash flows, and we said that depreciation will not suffer inflation. It means you cannot calculate or you cannot apply inflation of this 10% directly on the cash flows, which are going or which is going to be arrived after adding back depreciation with profit after tax. You cannot, because depreciation is provided on the historical cost. It will not suffer any inflation. It means you have to arrive at the cash flows without disturbing depreciation, but by including inflation. Okay, so how you are going to do that? Let's have a working note. We'll have working note 1 where we'll capture the computation part of operational cash flows. Okay, uh, so here where we are going to apply inflation, whether inflation can be applied on cash flows, the answer is no. Okay, then where we have to apply this inflation? This inflation have to be applied on the company's PBDT. Okay, so the company's PBDT as on 31st December is 10,000, and we are standing now on 1st January. Okay, so we have the first year end figure which is 10,000. So yeah, you cannot apply inflation because probably what we have to assume is that is taking care of inflation. Okay, for year 2 and 3 we have to provide for inflation. So let me capture that. Item number A, PBDT, that is profit before depreciation and tax, for year 1 that's going to be 10,000. For year 2 you have to apply 10%, so 10,000 multiplied by 1.1, so that includes 10% inflation. So 10,000 plus 10%, it's going to be 11,000. And for year 3 this should include 10%, that is 11,000 plus 10%, so it's going to be 11,000 into 1.1, so it is 12,100. So in this way you have your earnings before depreciation and tax after factoring inflation. Okay, now from this we can subtract depreciation. From this we can subtract depreciation, and we know that depreciation is a zero inflation item because this is provided on historical cost. And what is the depreciation amount? It is 2,000. So let's provide what is depreciation. It is 2,000. Fine. So now we can have profit before tax, PBT, which is A minus B, and let me calculate. It is 10,000 minus 2,000, 8,000 for year 1, 9,000 for year 2, and 10,100 for year 3. So this is my profit before tax. Let me go and find out what is my tax rate. 40%. So item D, let me put it here, item D, less tax at 40 percentage. So here let me apply. It's going to be 8,000 into 40 percentage, 3,200, 3,600, and 4,040. Okay, so now I can find out what is my profit after tax, which is item number C minus D. And let me capture them. 8,000 minus 3,200, 4,800, 5,400, and 6,060. But what is more relevant for me now is the cash flows after tax. Okay, So I'll have item number F, which is cash flow after tax, and that is item number E plus my depreciation, which is item number B. Okay, so my cash flows after tax is item number E, that is 4,800 plus depreciation of 2,000, so I get 6,800. Year 1, 7,400. Year 2, 8,060. Year 3. So these are all my cash flows. So once I have my cash flows, I can go and find what is required in the question. In question, they want us to find the present value. Now, these cash flows basically include inflation. So these cash flows are basically money cash flows, right? They are basically money cash flows. So if I want to find the present value of money cash flows, I have to discount the money cash flows at money discount rate. Only then I will be able to find out present value. So let me put that here. Working note 2. I'll have it here. Working note 2, computation of present value from money cash flows. So if you want to find out the present value of money cash flows, what is required is money discount rate. Without money discount rate, you cannot find the present value. So how do you find the money discount rate? We know the formula. It is 1 plus money discount rate is equal to 1 plus inflation rate multiplied by 1 plus real rate. So let me reproduce. Do we have the real rate? Let's check in the question. Do we have the real rate? Yeah, we have the real discount rate 4%. We have inflation 10%. So let's fill that. Inflation rate is 10%, so it is 0.10. And real rate is 4%, so it is 0.04. And if I fill this, let's see what happens. Let me take it to the separate cell. Okay, so here I have to introduce that asterisk, and once I do that, I'm getting 1.14. I'm getting 1.14. Let me extend this further. Actually, I'm getting 1.444. Okay, so now I can find my money discount rate. My money discount rate is nothing but this 1.144 minus 1. Okay, so this is 0.144, and if I express that in percentage, if I express this in percentage, let's see what value I get. If I express this in percentage, let me see, it is going to be 14.40 percentage. Okay, it's going to be 14.40. So in this way I have money discount rate, and I have money discount rate, and here I have money cash flows. So now I'll be able to find out what is present value. Okay, so what we'll do, we'll have a working note 3. We'll have working note 3 where we'll compute present value from money cash flows. So probably what I'll do in working note 2, I have indicated that we can compute present value from money cash flows where we have calculated money discount rate. So instead of opening a separate working note, I'll work in this itself. We'll have a column for year, then money cash flows. Then we have to discount these cash flows, right? We have to discount these cash flows at what rate? Money discount rate, which is 14.40 percentage. Then we can find the present value. Then we can have present value. So let me make it as a table. So table is ready now. Let me go and pick up how many years we have. Just now we have calculated there are 3 years. Okay, so year 1, year 2, and year 3. Fine. What are the money cash flows? Let us pick up year 1, it is 6,800. Year 2 it is 7,400, and year 3 it is 8,060. Now we have to discount these cash flows at what rate? 14.4. So I'll apply the formula 1 divided by 1.144 to the power the time period, which is year 1. Let me keep it at 3 decimals. For year 2, if I apply the formula, I'll get 0.764. Okay, and for year 3, my formula is 0.668. Now, if I multiply these two, okay, that is money cash flow with a discount factor, I get a value. Let me keep it with 2 decimals. So it is 5,944. 5,654 and 5,383, and if I total them, I should be getting the present value of money cash flows, which is 16,981. So in this way, we have answered the first part of the question, that is compute the present value. But the question says use the different method to arrive at the answer. I mean, don't confine to the present value only by using money cash flow. It means you can also find the present value using the real cash flow. So how can you find the real cash flow when you have money cash flow? It is possible if you can discount your money cash flow at the inflation rate. So by discounting the money cash flow at the inflation rate, you will find out what is the real cash flow. Okay. So what we'll do, we'll have working note 3. Working note 3, I'll say it is going to be computation of computation of real cash flow and present value. We'll find out what is the real cash flow, then we'll find out what is the present value. So we need a similar table. Let me copy paste. We need year, and that's going to be year 1, 2, 3. And let me just copy paste the money cash flow, because from money cash flow, by discounting them at inflation rate, we are going to find out the real cash flow. So money cash flows for 3 years information I'm just picking up from here, and it is 6,800, 74 and 8,060. Okay, now I have to discount. Okay, I have to discount at inflation rate, that is 10 percentage, to arrive at my real cash flow. Okay, to arrive at the real cash flow. So let me do that discounting first. That is 1 divided by 1.1 to the power the time period. So I get this discount factor. Let me keep it at 3 decimals. So I'm copying the formula, pasting for the remaining 2 years. So I'm getting these numbers. These are all the discount factors at your inflation rate. Now, if I multiply this money cash flow with the discount factor at inflation rate, what I get is real cash flow. So my real cash flows for year 1 is 6,800 into 0.909. I get 6182. Year 2, when I product these two, I get 6116, and for year 3 it is 6056. So now I have real cash flow, and what did I said? You can find the present value by discounting the real cash flow at real rate of return. It means now I can have one more column where I can discount these cash flows at real rate of return. So my discount factor at my real rate of return. And what is my real rate of return? Let's go back to the question. Question says my real rate of return is 4%. So my discount factor at real rate of return, that is 4%. So let me calculate. It is going to be 1 divided by 1.04 to the power the time period, and it is 0.961. In the same way, if I calculate for year 2 and year 3, I'm going to get these numbers, that is 0.962, 925 and 889. Okay. Now, if I multiply this real cash flow with the discount factor at the real rate of return, what I'll get is PV, present value. So my present value is nothing but the real cash flow multiplied by discount factor at 4%, and I get 5944 for year 1. Year 2 5654, year 3 5383, and if I total them, let's see what we get. I get 16,982, and here let me just round off this. Here also I get 16,982. So in both the cases I'm getting the same value. So you can approach the present value either through this real cash flow or through money cash flow. But what is important is when you approach through money cash flow, you have to discount at money discount rate, and when you approach through real cash flow, you have to discount at a real rate.